Here is a quick video on chapter 26 that deals with money and the monetary system, which includes the Fed, also known as the Federal Reserve. So there are three different definitions of money, going from the most specific liquid type of form of money called M0, or the monetary base, MB for the monetary base. There's also M1 and M2. M2 is all of M1, plus also savings deposits, time deposits such as CDs, M1 is currency, which means cash and coin, but it's only that money that's outside of the banks. So if I have $1,000 in my wallet and or at home, cash and coins, that's considered part of M1. That money is deposited in the bank, that is not part of M1. And it also includes checking accounts. So these are items that people generally accept to be money. So people obviously accept cash and currency. Checks are also broadly considered and accepted as money, so checkable deposits, that's just a regular checking account, and also traveler's checks. Not as important today. So M0, the monetary base, is the most liquid form of money that is considered all currency, all cash and coin. Doesn't matter if it's in the bank or out of the bank. And it also includes the Federal Reserve deposits. So any of the money that's on the account of the Fed. It excludes the checkable deposits, that's an M1. And M1, once again, only considers money outside of the bank, not money in the bank. And then we know that the Fed, the Federal Reserve, they have three main tools, if you will, at its disposal to affect the money supply and thereby affect the interest rate. And those are the required reserve ratio. When people deposit money into the bank, into their checking accounts, a certain percent of that money must be held either in the bank vault or at the Fed, on deposit at the Fed. So example, if it's 10%, if somebody deposits $10,000 into their checking account, the bank must hold on to as required reserve a minimum of $1,000. The remaining $9,000, that is excess reserves, and that can be loaned out, can be held in the bank, it can be invested by the bank as well. The second thing that the Fed uses is called the discount rate. This is the rate of interest that the Fed charges its member banks. So it's what the rate of interest that the Fed charges its member banks when they fall short of that required reserve ratio. They have to borrow money short term, they can go to the Fed. They can also go to interbank loans from other banks, and that rate, don't confuse it with the discount rate, that's called the federal funds rate, but the discount rate is what the Fed charges. And the last thing is called open market operation. This is the most important in the US, and it is when the government buys or sells bonds from the public. Bonds are also called securities. So let me give an example of how this works. Suppose the economy, so the problem in the economy is the economy is slowing down. Perhaps there's fears that it's going to enter a recession, or it is a recession. Well, the cure is to speed up the economy. The goal is you want more spending. Well, fiscal policy is through taxes and spending. We're looking at monetary policy. The monetary policy is the Fed using those three tools mentioned above to cause a change in the money supply, either increase or decrease in the quantity of money, also known as the money supply, so too as affect the rate of interest. And when the rate of interest changes, that affects borrowing. So if the economy is slowing down too much, fear of a recession, the goal would be we want more spending, more borrowing, so therefore the Fed would want to decrease the interest rate. If interest rates in the economy is lower than they would have otherwise been, lower interest rates result in consumers generally borrowing more money and spending more money. And also business investment, if the rate on a loan in the bank is lower, businesses also will borrow more, invest more, and this all leads to more spending, and these are components of GDP, so therefore GDP should increase, and therefore hopefully reversing the slowdown in the economy. So specifically, if once again the economy is too slow, to reverse this, our goal, we want to speed it up. The Fed can intervene, and they can change the required reserve ratio. Once again, the Fed wants more money to be circulated in the economy. So if they lower the required reserve ratio, that would make sense, because if the banks if the Fed, requires the banks to hold on less money, therefore the banks can loan more. Anytime more money is loaned, that's going to result in an increase in spending and speeding up the economy. Similarly, the discount rate. If the Fed makes it very cheap for banks to borrow money from them, therefore they'll feel as though they don't need to keep so much on reserve, they'll loan out more. And if there's a problem, they can just go to the Fed and get a loan at a very low rate of interest, and that's also going to lead to more money out in the economy, as these banks are more likely to loan out more than they would before if the discount rate was much higher. And lastly, once again, more important one, I'm going to abbreviate it, open market operation. This is when the Fed sells securities from the public. If, once again, the goal is it's too slow, the Fed wants to expand the economy, speed it up, they are going to buy, this is the Fed, is going to buy securities from others who already have those securities in what's called the open market. I'll go into this a little bit more in depth. So what happens when the Fed buys securities? Like any purchase, anytime someone buys something, that means someone else has to hold it or possess it. So the Fed buys security. This means someone in the public, a person, corporation, owns a security. So they own, I'm going to just write bond. So someone owns the bond. Well, if the Fed buys it, let's think about what happens to the flow of the money and the security. If the Fed buys the security, well, the person has the bond is going to go away from the person in the economy, and it's going to go to the Fed. Well, what does the Fed have to do? If the Fed is acquiring an asset that someone owns, what happens to the flow of money? Well, the Fed is going to have to pay for it. So they give money to the person who owns the bonds. Therefore, think this is the economy. Right now, more money is in the economy since the person gave the bond to the Fed, and the Fed had to give them money for it. So there's more money in the economy, hence that is going to speed up the economy and hopefully have the recession end sooner than it otherwise would have, as dictated by Keynes. So that's a brief review of chapter 26.